Welcome to the SchiffGold Friday Gold Wrap, your overview of this week's precious metals news. It's Friday, January 6th. I'm your host, Mike Maharrey. Thanks for tuning in. Well, y'all have questions. I have answers. 100% correct answers or your money back. Isn't that a great deal? Can't miss on that, right? So I mentioned last week at the end of the show that as you're listening to me now, I'm actually on vacation, sunning it up in the Caribbean. And I didn't want to leave y'all starting off the year with no Friday Gold Wrap podcast, so I decided, you know what? I'm going to do an Ask Me Anything episode. That way you guys will have some content. And I can do it way beforehand. So I'm actually recording this on the last day of 2022, but you're listening to it in the future. Kind of cool, right? So what I did was I just solicited a bunch of questions on my Facebook, and actually got a couple from email as well. And I got a lot of really good questions. In fact, I could do probably 3 episodes. So I just kind of picked the ones that I thought would work the best. For this particular episode, maybe I'll revisit this idea on down the road on some weeks that there's not a lot of news going on. Or maybe I'll do just like answer a question at the end of every episode or something if this goes over well. So let's get to the questions. The first one came via email. Jim asked, what is your educational background? That one's easy enough. I actually have 2 undergraduate degrees. Like most people, I went to college right out of high school. The University of Kentucky, ended up earning a bachelor's degree in accounting. Quite frankly, didn't have any interest at all in accounting. At that point, I was going to be a rock and roll musician, and actually was a musician professionally for about 10 years. And so I never actually did accounting. And my real passion has always been writing. So in 2006, I went back to school to the University of South Florida and got a second undergraduate degree in journalism. So if people ask, I usually say I'm trained as a journalist because that's the thing that took. I worked in news for a while, both newspaper and television. And so, writing again is my passion. But doing this, working for SchiffGold, that background in business from an academic standpoint has turned out to be pretty darn handy. 2 things work together as kind of an economic journalist. Interestingly, I was talking with Jeff Deist. He's the president over at the Mises Institute not too long ago, and we were just discussing the fact that economic narratives are generally pretty bad, especially if you're talking about economic history. And I think that's because, and this was Jeff's theory as well, I agree with him, historians tend to write the narratives. And historians generally are much better writers than economists. We need more economists who are good writers and storytellers. And Henry Hazlitt was actually a journalist. He was not an economist by training and wrote arguably one of the best books on economics ever written, Economics in One Lesson. If you've never read that, I highly recommend it. It's an easy read because he's a journalist and he knows how to make things make sense. I would like to think that I have that talent, maybe not quite to the degree of old Mr. Hazlitt. All right, next question comes from Jason. He asks, why is silver better than gold? I'm not sure I really get this question. Obviously, Jason's making an assumption. I'm assuming he thinks silver is better than gold, and I'm supposed to agree with him. Jason has a pretty good sense of humor anyway. I would argue that silver isn't better than gold, but it is certainly different. And because it is different, it might be better in terms of investing for certain people. It really depends on your goals and objectives with investing. The biggest difference, I think, between gold and silver is that silver obviously is more of an industrial metal than gold. Both of them have industrial applications. Gold is used quite extensively in technology, but it's usually nanoparticles and some in electronics. But the offtake for gold in terms of industrial use is much lower than silver. Silver is 50 to 60% of its demand comes from industry. As a result, silver tends to be more volatile than gold. If you look at the price fluctuations day to day, month to month, you'll see much more up and down movement in the price of silver because it is an industrial metal to the extent that it is. You will see demand ebb and flow. When you have economic downturns, the demand for silver will drop off as industrial output slows down. So that kind of accounts for that volatility. That being said, at the core, silver and gold are both monetary metals. And if you look at the trajectory of the two metals over the long run, they tend to run in parallel. And interestingly, historically, silver has actually done better in gold bull markets than gold. We saw this recently after the 2008 financial crisis, where silver, went far ahead of gold in terms of percentage change in price. Same thing happened during the pandemic. So when gold starts to run up, silver starts to run up as well, and it tends to outperform gold. You can kind of see this in the silver-gold ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that's extremely wide, and that indicates that the next time that we start to see gold running up, silver will, in all likelihood, if you believe historical trends, will run up even faster. Of course, another big difference between silver and gold is that silver is much less expensive. You can buy an ounce of silver right now for $25 an ounce. And then gold, of course, is just over $1,800 an ounce. So if you are an investor that doesn't have a lot of capital to invest, it's much easier to get into silver. You can get an ounce of silver much more easily than you can get an ounce of gold. And therefore, I think for a lot of people with more modest incomes, silver is a better investment simply because it's more affordable. I also think that, kind of looking at why you might hold gold and silver. If your concern is a currency collapse or hyperinflation, if you're looking ahead and thinking, I might need to use precious metals in order to obtain goods and services, I think you definitely want to hold silver, as it's much more easy to do everyday transactions in silver than it is in gold. Obviously, if you have an ounce of gold, it's worth $1,800. It's hard to make change. Whereas if you have a small piece of silver, it's much more easy to exchange that for, say, a carton of eggs. I kind of like gold as kind of my long-term protect wealth, and then I hold some silver in the event of currency collapse or some type of event where geopolitical collapses occur. So I don't think gold is better or silver is better. I think they're different. They have a little bit different roles, and you just kind of have to look at, what your investment goals happen to be. Now, Jess emailed me, and this is along kind of the same lines, also talking about silver. He asked, considering that the ultimate end destination for all of this monetary nonsense is most likely a hyper-stagflationary depression lasting upward of a decade, and I kind of agree with this. We know that gold does well in stagflation, but what about silver? Given silver's industrial uses, can we expect investment demand to compensate and provide a significant enough monetary tailwind for it also to do well? I think, again, historically, yes. And I touched upon this earlier in my last answer to Jason. Historically, silver has actually outperformed gold in these gold bull markets. But Jess does bring up a valid point. If we are in a global downturn, you're definitely going to see the industrial demand for silver drop. But given silver's primary monetary characteristics, I do think that investment demand will help compensate for that, because that's what we've seen historically. There's another aspect to this as well. I think governments are going to kind of prop up silver demand. Silver is a big factor, a big resource necessary for the green energy movement, particularly solar. It's also being used in the development of 5G, and government heavily subsidizes this stuff. I don't see any reason to believe that all of a sudden governments are going to stop subsidizing solar. So that aspect of solar demand, I think, will probably remain pretty consistent and robust. But even so, again, just looking at history, silver has tended to move up and down with gold and silver silver has tended to move up and down with gold on a pretty consistent basis, and that would lead me to believe that silver will do well in this hyper stagflationary depression if that is indeed what comes along. Next question. I didn't write down who asked this, but the question is, what's the increase in debt default for consumers, so credit cards, mortgage, student loans, etc., since the Fed rate hikes? That's a good question. So we've certainly seen interest rates spike significantly. Credit card interest rates are now at the highest level ever. They're knocking on the door of 20% in a lot of cases. So as the costs of debt go up, as people are more and more indebted, you would expect to see more defaults, which is certainly what we've seen in the past in these kind of debt-ridden cycles. So interestingly, delinquency rates are actually still below pre-pandemic levels, but they are rising. And I didn't look up the exact numbers, but we got the third quarter household debt report about a month and a half ago, and this comes out from the Federal Reserve, and this is what they said. They said, quote, "The share of current debt transitioning into delinquency increased for nearly all debt types following 2 years of historically low delinquency transitions." So delinquencies were historically low for a couple of reasons. Number one, a lot of companies, particularly mortgages, they were required by law, student loans also required by law to give amnesty and extensions for paying on debt. So nothing went into delinquency during the pandemic. And then, of course, we got these multiple rounds of stimulus, and a lot of people used that stimulus money to pay down credit card debt. Credit card debt dropped precipitously during the pandemic era. So now we're starting to see that build back up, but the delinquencies haven't quite caught up yet. So they're rising. It is concerning if you look at the trend, but if you look at the raw numbers, delinquencies are still relatively low in comparison with where they were before the pandemic. So I think this is going to be an increasingly big problem moving forward into the next year, especially if the Fed manages to hold those interest rates high. You're going to see more and more people begin to default. The housing market is a mess right now, and at some point, I think the dam is going to break there too. So you'll see a lot of foreclosures, and so I think this is a problem in the making, but it hasn't bubbled up to the surface yet. Okay, Rachel asks, why isn't gold and silver currently valued higher? I think a lot of people are asking this question. We just went through a year of significant price inflation. In an inflationary environment, you expect precious metals to do well. They're considered inflation hedges. And a lot of people look at the price and say, what has happened? Why haven't we seen gold and silver rise precipitously? Obviously, I'm recording this on Saturday, the 31st. It looks like gold closed out the year right around $18.20 an ounce. Hold on a second, let me look. Yeah, so gold is at $18.24. That's the spot price right now. And it actually closed out December 31st in 2021, right around $18.20 an ounce. So we've had a sideways trade. You haven't earned any money on your gold. You haven't lost any money. And it's interesting because a lot of people, again, think, oh, gold just did awful this year. Well, it didn't do nearly as awful as stocks, which crashed, bonds, which crashed, crypto, which crashed. So gold and silver did actually serve as a hedge if it is part of your portfolio. I have to emphasize that fact. But I think it is fair to look at it and say, well, why wasn't it higher? It seems like it should have been higher. And the main reason for that is the headwinds created by the Federal Reserve tightening monetary policy. Rising interest rates are always considered a negative for gold. Gold is a non-yielding asset, as is silver. And by non-yielding, it doesn't pay interest, right? So if you buy a bond, you pay $100 for a bond. Every month, you're going to get a little interest payment from that bond. It's yielding interest. Gold doesn't do that. It just sits there. The value of gold increases primarily due to the depreciation of currency. So as dollars devalue, the price of gold rises. We saw this in the Eurozone, where gold was actually up 6 or 7% this year in euros. So, if you're looking at it in dollars, we're flat. In many other currencies, gold did very, very well. But it is not a yielding asset. So when you start seeing interest rates rise, a lot of people will try to get out of gold. They want to get into things that are yielding higher returns. And so I think as the Fed has raised interest rates, as there's been this perception that we're fighting inflation, we're going to slay inflation, there has been some spurning of gold and silver in the markets, particularly when it comes to institutional investors. And I've talked about this before on the show. We've had very little demand for paper gold ETFs. A lot of metal has come out of the ETFs. Physical gold, though, the demand has been very, very strong. People have been buying physical metal. We've been seeing physical metal pouring out of the COMEX vault. So people do want gold, but the big institutional investors that tend to drive price in the short run have kind of been out of the market. And I think that's primarily why we haven't seen gold move higher than it has. Brian asks, what are a few steps anyone can and should take to increase their financial solvency within the next 5 years? Great question. I will start this with a caveat that I am not a financial advisor. I have no credentials to make me a financial advisor. This is Mike Maharrey's opinion, an educated opinion, I would argue, but my opinion purely. So, don't say, well, Mike Maharrey said, and then, come back at me in 5 years if you're broke. But, I have 4 steps here that I think are important. And honestly, they're probably going to sound pretty boring and common sense. But as with most things, I think you need to start with fundamentals. Number 1, get out of debt. With a higher interest rate environment, debt is crushing right now. If you're paying 20% interest on a credit card, you making minimum payments, you're never going to pay that down. You're just paying for interest. And then, of course, if you're in a lot of debt, it's a lot of your cash flow is being diverted. Get out of debt. We can debate whether or not you want to get out of your mortgage, pay your mortgage off. I think you can make a case if you are in a mortgage. If you got your mortgage a couple of years ago when we were at these extraordinarily low mortgage rates of 2, 3, 4%, it makes sense to go ahead and keep paying on that mortgage as long as your cash flow is good. But credit cards, auto loans, all of this high interest debt, try to pay it off and open up that cash flow. Number 2, create multiple streams of income. Get a side hustle. Diversify yourself so that if something falls apart, if we dive into a deep recession, you lose your job, maybe you have some other income coming in that will help ease that burden. The more streams of income you have, the less vulnerable you are to something happening in the economy. So, side hustles can be fun too. Find something you're interested in. There's all kinds of things you can do as far as e-commerce. If you're into photography, there's all kinds of things that you might be able to monetize, even if it's just a little bit, by doing something you already enjoy. So I highly encourage trying to find a side hustle. Number 3, start saving. Use the money you're saving that you're not having to spend because you're not paying on all of this debt, and put it into savings. Make it a habit, even if it's as little as $10 a month. Put some money away each month, and that money will begin to build. And as you get into the habit of saving, it becomes easier and easier, and then it becomes a challenge, and it's like, ooh, I want to put in extra money this month. As you save, I would recommend not holding a lot of money in cash. just leaving it sitting in a bank account. Put it at least in a money market. Money markets are paying a pretty good interest rate right now, with interest rates higher, so you can save there. If you're planning on saving for long term, you can go ahead and put it into precious metals. Save up $1,800 and buy a gold coin, or save up $100 and buy $100 worth of silver, and that'll help minimize the inflationary hit you're going to take holding cash. But definitely save. You want to have savings. Again, this is your security blanket if something happens with the economy, with your job. So multiple streams of income, saving. And then from an investment standpoint, again, I'm not an investment advisor. So just some general things that I think and that I'm kind of trying to do with my portfolio. Expect an ongoing inflationary environment, so you'll want to get out of dollars. I like commodities, including, of course, gold and silver, but also agricultural commodities, oil, industrial metals, things that are going to go up in price as the dollar crashes. And you kind of have to look at these things. Obviously, industrial metals, if we go into a deep recession, they may not yield as much as they would otherwise. But typically, commodities are good in an inflationary environment. And I like emerging markets. If you're looking at stocks, foreign countries, emerging markets, they tend to do well when the dollar is weak. And I think we're going to see dollar weakness in the years ahead. So you might want to look at emerging markets. As far as, American stocks go, I would stay out of the speculation. I would look at solid companies that are earning money, that will continue to earn money in a recessionary environment, that pay dividends, not these companies that aren't even making any revenue. We saw this huge stock market blow up, the stock market bubble blow up over the last decade or so because of all of the easy money that's out there, and that has been feeding this speculative mania. So you've seen these tech companies and startups and IPOs and all of this mania, where people, they've got this extra money and they can borrow money and they can do leverage and they can put all of that's crashing right now. So solid companies that have been around, that are earning income, paying dividends. That's what I like. Mike asks, I hear China is manipulating the gold market. True? How should we think about nations and their gold supply? I don't think that China is manipulating the gold market as such. I tend to be skeptical of the manipulation narrative. Gold is a multi-billion-dollar market. It's hard to manipulate it, especially over the long term. I'm not saying that manipulation doesn't happen. We know that it does, but this tends to be a short-term thing. So somebody might be able to, do a huge buy that pushes the price up momentarily, and they'll take advantage of that. That kind of manipulation happens for sure. Happens in all markets. Let's be honest. In the era of computer trading, you can dump a bunch of stock or dump a bunch of gold and impact the price and then play in it. People use it to get out of their shorts or get out of their longs or whatever. So that happens. But I don't think that there's this long-term manipulation of the gold market. Now, I do think that China and many other companies are getting more gold. I mean, that's obvious. We can look at the just looking at the central bank gold buying over the last year. In the third quarter, we had a mystery buyer in the central bank world, which was probably China. And other countries are doing it as well. India, a lot of emerging market countries are getting gold. And quite simply, they're trying to get out of dollars because they recognize the same thing that I've been talking about. The dollar is getting shaky. And I think that at some point, the dollar is no longer going to be the sole reserve currency. The U.S. has basically used the dollar as a foreign policy weapon. People don't like that, and they don't want to be vulnerable to the U.S. and U.S. foreign policy. So they are looking for ways to diversify away from dollars. Gold is the best diversifier there is. Gold has been money for 5,000 years. That's why these central banks are accumulating gold. I think we are moving toward a time when the dollar is no longer dominant. Dollar hegemony is coming to an end. I don't know exactly what will replace it. Maybe gold will once again become kind of the reserve currency money in the world. I would expect maybe some type of basket or something. But regardless, you're going to see a decline in the dollar over the years ahead, and I think that's why a lot of countries are accumulating gold. But I don't think that it's really right to call it a manipulation. So Brandon asks, why are premiums so high on American Silver Eagles? Is it something to do with a law that the government has to have silver to sell and they are running low? This is stuff I heard on YouTube. Well, Brandon, yeah, that's kind of right. Basically, a shortage of silver planchets is what is behind the high premiums on Silver Eagles. So planchets are the silver discs that are used to strike coins. Basically, they're slugs, right? The U.S. Mint does not create its own planchets, and it must obtain them from outside sources. So this is from a Coin Week article a while back. The planchet shortage, say that 3 times fast. The planchet shortage has resulted in a coin production shortage, with the mint having struck only 12.8 million Silver Eagles through September 2022. It was twice that amount in 2021, with demand at a similar level. So that's pushed premiums way up, perhaps to the highest levels over spot ever seen. So a little background, the American Silver Eagle program started in 1986, and of course it was authorized by Congress, and the law that created the coin specified that the silver had to come from silver mined in the U.S. Now, this wasn't a problem at that point because they were getting silver from a thing called the Strategic and Critical Materials Stockpile, which was created in 1968. So in the 80s, it was no longer viewed as needed, so they just pulled silver out of that. Once that stockpile was gone, Congress changed the law and specified that the mint must purchase silver mined within 1 year, so it has to be within a year old, and it cannot use recycled silver. Not exactly sure what the reasoning was. I think they thought it would save money. But the bottom line is the mint has had a hard time getting these silver planchets under the limits that the law places on it. And so we've seen a shortage of Silver Eagles and very high premiums. And so, if you look at Canadian maple leafs or other silver coins that are minted out there, they've not had quite the same increase in premium as we have with the U.S. Eagles, simply because the dumb U.S. government has created a situation that was ripe for a shortage. Heather asks, what states have the best policies when it comes to gold, other precious metals, and bullion? That's a great question, and I have the answer for you. There's an organization called the Sound Money Defense League that has a sound money index. These folks are really good. They do a lot of state-level legislative work to promote sound money. And based on this index, Wyoming, Texas, and South Dakota are the 3 most pro-sound money states in America. If you're interested, Vermont is ranked dead last. Alaska, New Hampshire, and Utah also scored very high. So their index is based on tax policies, whether a state recognizes the monetary role of gold and silver under the Constitution. So, for instance, Utah actually recognizes gold and silver as legal tender. Whether a state holds pensions, reserves, or bonds in gold and silver, whether a state has imposed precious metal dealer, investor harassment laws, and other criteria. I know Texas scores very high because it actually has its own gold depository. So those are the strongest sound money states based on this criteria. One of the things that we really promote over at the 10th Amendment Center is just getting rid of the taxes on gold and silver. There are still several states that have a sales tax on gold and silver. Now, we've seen those start to disappear and be repealed, which is good because, why would you tax money? It's ridiculous. So hopefully we'll see more states continue to promote sound money. Because here's the thing, when states promote sound money, particularly gold and silver, it creates an environment where we can have some type of currency competition with Federal Reserve notes. The less barriers you have to using gold and silver as money, the better. And obviously a tax is a barrier to not only investing, but it's also a barrier to actually doing transactions. So in a world where we're seeing more and more the ability to use blockchain and cryptocurrency backed kind of things where we can actually transfer gold and silver without actually having to hold the metal in our hands, there's an opportunity to do business in sound money and undercut fiat currencies. So it's really important for states to take these actions. And if you live in a state, you might want to look and see what your state can do to help promote sound money. I'm going to do one more. I'm getting very long here, but one more good question. Thomas asked, is it constitutional for a state to issue a gold-backed stablecoin? So for folks who don't know, stablecoins are cryptocurrencies, and their value is pegged to another currency or a commodity or a financial instrument. So basically, you'd have a stablecoin that is pegged to gold. So its value would be based on the price of gold. So the question is, can a state issue a stablecoin that's backed by gold? I would argue that from a constitutional standpoint, it is not constitutional. Article 1, Section 10 prohibits states from coining money. Now, a lot of people want to take that literally and say, well, a state can only prohibits states from making coins. But that really isn't, I don't think, what the meaning of coining money was from a constitutional standpoint. It's very important when you look at constitutional interpretation to look at what words meant in a legal context when the Constitution was written and ratified. And if you go back and you look, there was a secondary definition. The primary definition of coining was to actually stamp a coin. But there was a secondary definition of coining money, which was basically to produce money. And that was widely used in the general public. So my view is that the states are prohibited from issuing any type of currency or creating any kind of money. If you look at the context of this provision in the Constitution, the founding generation thought it was very important to have a uniform currency throughout the United States, and that's why they prohibited states from creating money. So I think if you take the spirit of what the Constitution meant in the definition of coining, my argument would be and here's the thing. I always take the most strict interpretation as possible. And so I do think that that's a prohibition to the states. Now, that does not stop an individual or a private entity from issuing a stable coin backed by gold. In fact, we have these things called gold backs, which kind of came out of the Sound Money Act that was passed in Utah a number of years ago when they recognized when Utah recognized gold and silver as legal tender. A company was formed and basically became a kind of a gold bank and a private gold bank that allowed people to transfer gold back and forth, to transact business in gold. And they created these things called gold backs. So they're actually printed currencies, but they have a small amount of gold in them, and they're valued based on that small amount of gold. So it's in essence a currency that is backed by gold, or that it is gold. And so a private organization absolutely can do this, and there's no problem with it. But when a state does it, I think you do run into constitutional issues. So that is our Ask Me Anything. Like I said, that's probably half the questions that I got. So maybe I'll do some more, or like I said, maybe I'll start doing like one question a show or something if people are really interested and think this was fun. I hope you did enjoy it. I hope you're having a great beginning of the new year. And of course, I'll be back next week, hopefully a little bit more suntanned and relaxed, and we'll get back into the business of business and gold and silver and all the things going on in the economy. Until then, that's a gold wrap for this week. And of course, as always, you can get more details on all of these stories and more. Keep up with the latest precious metals news and analysis throughout the week over at SchiffGold.com/news. If you haven't done it, should be your New Year's resolution. Subscribe to the Friday Gold Wrap. You can do it at Apple Podcast. You can do it at Google Podcast. We're on Stitcher. We're at YouTube. Links to all of this stuff is on the show notes page. You can also email me, Maharrey, gosh, I can't even spell my own name, Maharrey at SchiffGold.com. You can email me there. You can send me questions, and maybe we'll answer them on the show. That's it. Have a great day. I'll talk to you next week.